You enter a breakout as the price surges, feeling validated by the momentum. Seconds later, a violent reversal erases those gains and liquidates the position, leaving you wondering how the trend shifted so fast. This scenario is increasingly common because the market is currently broadcasting two contradictory signals. One suggests an imminent pump, while the other indicates the broader decline is far from over. Short-term mechanics are building heavy pressure for an upward move, even while the macro-mathematical structure indicates the primary trend remains unchanged. By the end of this breakdown, I will reveal the specific mathematical candlestick formula institutional traders use to filter out this noise and identify where the real trend is heading. Looking at the immediate structure, Bitcoin has confirmed multiple 3-day candle closes above the $76,000 resistance zone. While those closes look bullish on a standard chart, the real target becomes clear only when we look beneath the price action at the order book. This heat map reveals a massive concentration of liquidity sitting at exactly 79.6K. This cluster represents thousands of retail traders opening short positions and placing their stop losses in the same narrow zone above the current price. Funding rates across major exchanges are now flashing a warning. Because funding is negative, shorts are currently paying a premium to longs to keep their positions open. This creates a direct financial incentive for larger market participants to drive the price upward, triggering those stop losses and clearing the board. When we connect these negative rates to the 79.6K cluster, the path for a short-term squeeze becomes highly probable. This suggests that current price action is being driven more by the technical pursuit of liquidity than by a fundamental shift in market sentiment. However, this move to 79.6K doesn't happen in isolation. It relies on traditional financial markets providing a supportive environment. If the US stock market opens the week holding its all-time highs, it provides the momentum necessary for Bitcoin to execute this liquidity grab. If stocks falter or reject, the crypto squeeze setup loses its primary engine and will likely fail. While Bitcoin eyes that liquidity, Ethereum is experiencing the calm before the storm. Volatility on the 4-hour chart has dropped. It's reached a level rarely seen over the last several months. Historically, these periods of flat sideways action are the precursors to sharp, volatile price movements. For Ethereum, the critical levels to watch are resistance at 2.4K and support at 2.3K. We see similar pressure building in XRP, which has faced repeated aggressive rejections at the 1.45 to 1.47 zone. Solana is also at a crossroads, holding a major support zone between $85 and $86. The altcoin market is effectively waiting for Bitcoin's liquidity hunt to act as the trigger for its next move. These short-term pumps have many retail traders convinced the bear market is over. Relying on standard candlestick charts can be misleading. These charts display every algorithmic fluctuation, making it difficult to see the underlying trend. Institutional traders solve this by using monthly Heikin-Ashi candles. This isn't a subjective indicator, it's a statistical recalculation. The Heikin-Ashi close is determined by averaging the open, close, high, and low of the entire session. The open is even more significant, calculated as the average of the prior candle's open and close. This ensures the current candle is mathematically linked to the data of the previous one. The result is a chart that smooths out counter-trend rallies to reveal the primary momentum. To understand the importance of this, we only need to look at the bear markets of 2018 and 2022. In 2018, standard charts showed relief rallies as high as 30%, but by switching over to monthly Heikin-Ashi, those rallies disappear. Throughout those 30% pumps, the candles remained red, signaling to institutions that the trend had not actually reversed. The current monthly Heikin-Ashi structure is displaying a similar pattern to those 2018 rallies. Price is rising, but the indicator has yet to turn green. Without this filter, it is easy to mistake a mid-cycle liquidity grab for a new bull market. Trading this environment requires navigating two timeframes, profiting from the short-term squeeze while remaining cautious of the macro trend. For these high-precision moves, I use the BingX exchange. BingX is designed to handle liquidity grabs with minimal slippage, which is critical when the market is hunting stop losses. You can find my referral link in the description and the pinned comment. Using that link provides you with exchange bonuses and direct access to my trading insights. The institutional data we just covered, like the Heikin-Ashi math, is what defines a professional edge. Subscribe to Crypto Whale Radar to stay updated on these shifts before they happen. Professional trading involves integrating these long-term signals with the speed of execution provided by BingX. In the immediate term, we are watching for that negative funding squeeze to drive the price towards 79.6K. Compare that to the macro signal. Long-term portfolio capital remains at risk until the monthly Heikin-Ashi candles finally flip green. Misidentifying the trend is only one way to lose capital in this market. The most common mistake is failing to manage risk during the high volatility of weekend setups. Click the video on your screen now to see the risk management framework I use to protect my capital through these cycles. I'll see you over there.